All right, happy Earth Day. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, an eerie calm settles over Wall Street this morning as investors take stock of the Sell America trade.
This month is shaping up to be one of the worst Aprils since the Great Depression for the Dow Jones Industrial Average.
And earnings kick into high gear. Corporate America offering more clues on the real cost of that tariff uncertainty. All that and more coming up, but let's take a look under the hood and talk about Tesla. Reporting this afternoon as the company tries to navigate brand damage from Elon Musk's work in the White House, but shares currently higher by about 1.4%. We'll see if that lasts.
All right, Northrop Grumman has cut its earnings outlook for the year. Manufacturing costs rose due to a change in the production process, and those shares have been literally decimated today.
I am also looking here at Verizon because they had lost more customers than expected last quarter due to heavy competition in the wireless space. Verizon down 5% pre-market, Katie.
And breaking just now, the IMF sharply lowered its global growth forecast for this year as Trump's tariffs spark a global trade war. Let's discuss now with Bloomberg Chief International Economics and Policy Correspondent Mike McKee. Mike, the number here, the big headline, IMF cuts 2025 global GDP growth forecast to 2.8% from 3.3%. And I think we can guess it has something to do with trade.
It has a lot to do with trade. The IMF saying that it is so difficult to put together a forecast. They had to do 3 or 4 of them. They had to start all over again when Donald Trump announced tariffs. And this is what they call their reference forecast, the one they're kind of going to work off. But they say lots of things are still possible. But as you mentioned, a big drop in global GDP is forecast for this year from the IMF. The growth slowdown will create disinflationary pressures. We'll get a little bit of inflation, but not as much because the economy of the globe is going to slow down, so only 0.1% up. But country by country, the outlook is grim, especially for the United States. The IMF is now forecasting a growth rate of 1.5% for this year. That's down almost a full percentage point from where they thought we'd be just a couple of months ago in January. And what also sticks out is China, 3.2%. That would be the lowest in decades for the Chinese. They're going to be, of course, a big part of the Trump tariffs. For inflation and unemployment, it's the same story. Inflation higher in countries around the world, unemployment higher in countries around the world. And so it's going to be difficult to see much good news out of the IMF. And they do, as I mentioned, fall back on blaming Donald Trump. The IMF chief economist saying, unlike in the previous century, remember Trump was always talking about the McKinley era and the era of tariffs in the 1920s, the global economy is now characterized by a high degree of economic and financial integration with supply chains and financial flows crisscrossing the world, whose potential unwinding could constitute a major source of economic upheaval. And that's what the numbers seem to show.
Mike, I want to hone in on the U.S. in particular. Not only was the forecast for growth cut, the forecast for U.S. inflation was roughly 1 percentage point higher to 3%. Amid the many challenges the Federal Reserve has to face right now, particularly political challenges, this is a picture consistent with stagflation, isn't it?
It is. The economy slowing and inflation rising is exactly what the Fed is afraid of because they're caught. They can't raise rates to stamp out inflation without helping slow the economy and vice versa. So this is going to be a tough situation for them. Now, the IMF does think that inflation won't go up as much as it might otherwise under tariffs because they're going to slow the economy so much. And so the Fed, Jay Powell talking about it last week, might wait a little longer to see if some of the inflation we get starts to fade as the economy does. But they're still going to have to make a tough choice at some point.
All right, Mike McKee, thanks very much for that. Michael McKee talking to us about the IMF cutting its growth forecasts. Right now, I want to focus in on Tesla because after the bell, it will report earnings. It has faced growing backlash, obviously, from Elon Musk's ties to the White House. Shares are down 43% this year. Bloomberg Technology's Caroline Hyde is here to explain what investors are looking to see on the call.
Well, on the call, some hype, some injection of enthusiasm coming from one Elon Musk, because that's what he usually manages to do. Strip away the fundamentals, get more excited about the future, because this company is trading at 78 times its current price. So prices at currently future earnings 78 times that. This is a company that trades on hope for robo-taxis. Will we start to see the proof in the pudding in Austin come June? What about the self-driving? Also about a cheaper Model Y as well. We're expecting that in the first half of the year. The reports have been from Reuters and the like that a cheaper version of Model Y is being pushed back by another 3 months. So how they could take on the BYDs, the cheaper competition over in China. All of this needs to be given more specifics, because right now we're just trading on bad politicization, an issue of European and US sales falling. We saw ugly vehicle sales in the first quarter and ugly quarter for the stock. It had its third worst quarter since its IPO in 2010.
Caroline, I want to shift gears. I want to talk about Amazon as well.
Yeah.
The reason being, you have another report now. Wells Fargo saying that Amazon is pausing some data center leases. Everyone might remember when TD Cowen said the same thing about Microsoft. Twice, and it was a big dispute on whether that was happening or not.
What actually is a lease?
What is a lease? What's a promise if you don't write it down on paper? I mean, Amazon, how big of a move is it, and how frightening is it to investors to see these types of CapEx expenditures paused?
It was frightening for European power investors. You saw Schneider Electric, some of those electricity providers to the future of AI, take a bit of a knock on the fact that Wells Fargo is putting out. Look, all of this is so couched in murkiness. Overall itself, Wells Fargo is saying it's hard and it's not clear as to whether AWS is slowing some leases in the area of concern or whether these are just natural ebbs and flows. We're trying to understand how much they're pulling back from leases in Europe, how much they're pulling back internationally rather than trying to double down here in the United States. It is notable on LinkedIn, AWS, well, one of the executives, Kevin Miller, came out saying, can I bring you some clarity here? We are not changing our overall demand outlook for artificial intelligence, for generative AI, and we're not pulling back overall in our offering of data centers. So he's trying to make clear that this is just a natural course of business, that they're doing their due diligence, they're trying to rein in costs, perhaps. But all of this just adds to that anxiety that you've got Microsoft and AWS just being more picky. Why not be going pedal to the metal at the moment in terms of your overall allocation of capital expenditure? Why not be getting lease after lease if we're still talking about insatiable demand for generative AI more broadly?
Some of the big questions as we head really into the heart of earnings season. Caroline Hyde, great to see you. You can catch her on BTech at 11 a.m. But we have some breaking news right now, and that is Boeing has agreed to sell its digital aviation solutions assets for $10 billion to Thoma Bravo. Bloomberg's Benedict Campbell joins us now. And Benny, we know that Bloomberg had reported that they were looking at this, that they were getting closer to a deal. You can see Boeing shares up about 3% right now. What do we know about this deal so far?
Hi, so we've known for a while that this is something that Boeing is looking at selling. This is a very profitable business. It's one they bought for a fraction of that price about a couple of years ago. And as they were looking at their portfolio and looking at what they might want to keep, what they might want to sell, this was always top of the list. And now it's confirmed. We had the scoop yesterday. Shout out to the team that this would happen. And now it's been confirmed by Boeing. The company reports earnings tomorrow, so we'll get a lot more details on that. But this is somewhat expected, but it's a good price they're getting, and it gives them a lot more financial firepower, which they'll surely need given the difficult market they're operating in.
I got to ask about Northrop Grumman. The company's been decimated, really, reduced by a tenth after it came out with an earnings miss. What's the story there?
It's a very Northrop-specific story. Generally, sort of defense contractors, the primes, have been doing pretty well in this climate. There's a sense out there that, given everything, that there's still money to be spent on defense assets. But Northrop, as you said, down almost 10% in pre-market at one point. The story is that their B-21, that's their sort of advanced long-range stealth bomber, that's going to cost them more to build. They've been taking a bunch of charges on that in the past, but they've added some more on that as a result. result. They've reduced their forecast for the year. So a fairly specific program story there for Northrop that doesn't really speak to the broader industry, but there's a lot of insecurity out there. We've heard it from a couple of other companies. Lockheed reported today, RTX reported today, and they've all said, the tariffs and the general climate certainly aren't helping in terms of the outlook. So you see some insecurity in that industry.
Yeah, it's a good point that Northrop is a standout in a bad way when it comes to the rest of the industry. Bloomberg's Benedict Campbell, great to see you. Meanwhile, check on these broader markets right now. You're seeing some green on the screen when it comes to the S&P 500, higher by about 1% in the pre-market. We know we had a pretty rough day yesterday for really all American assets. You see a little bit of a bid coming back right now into the bond market, into our currency market, but that gold bid continues. Now, coming up, markets discovering, like I said, that the real Trump trade perhaps is to sell America. We'll take a look at today's big take next. This is Open Interest.
We're sort of in this growth scare phase, which is similar to the 2010, 2011, 2015, 16, and 2018 drawdowns, where there was real fear of a recession or a big systemic crisis, but it did end up happening, right? It was a near miss. That's what we're pricing in right now. So the market is clinging to some hope that we can avoid a big crisis and that we can avoid a recession.
That was Lori Calvasina, RBC head of U.S. equity strategy, speaking this morning on Bloomberg. Now, there's so many superlatives we could give you an answer to that question. It's the worst start to a presidential term for the S&P since at least 1928, the worst April for the Dow Jones Industrial Average since the Great Depression. But I think this one speaks the biggest or the loudest. This is U.S. stocks versus the rest of the world, ex-U.S., and it's the worst underperformance for U.S. stocks as measured by the S&P in 32 years. So the question is, will international investors continue to rotate out of U.S. stocks into the rest of the world? Let's put that question to Michael Ball. He joins us here on set. He covers stocks for us at Bloomberg News. So, Michael, what do you think about the incredible underperformance of U.S. stocks, and will it continue, the sell America trade?
I think so. I think until we get certainty on policy, which doesn't seem to be coming anytime soon. I'm not just talking about trade policy. I'm talking about the overall picture of policy, which could be taxes, which could be immigration, which could be other things like regulation, all of which are still TBD. We're not going to be able to really price assets properly. And, markets need certainty. Then we can have an idea of where fundamental valuation should be, and then we can trade around those. Until then, unfortunately, it's going to be very choppy and volatile across assets.
Well, speaking of across assets, one thing I've been wondering about is, Matt, while you were here yesterday, Katie and I were talking a lot about gold.
It was a lot of fun.
It was a lot of fun, for the people especially that are, melting their gold jewelry.
I've got a ton under my mattress right now.
People actually do that. But at these levels, can that continue to be this much of a haven?
Yeah, that's a great question. I actually wrote yesterday about copper, which was being bid up as well because you can get gold out of copper. So smelters in China are actually incentivized to do that. So the gold trade is definitely looking like it can get some further traction as long as the uncertainty in America keeps the dollar under pressure. Obviously, gold is priced in dollars and people want to get out of U.S. assets. But it is overextended at this point, and I think we've talked about it in different things through MLive, where if we look at gold to silver ratio or we look at other sort of historical gauges, it is definitely overbought at this point. But with that said, the fundamentals still support it.
To be clear, I don't think we recommend doing that at home, melting copper to try to get gold out of it. But let's talk about a haven that hasn't been. And you mentioned the U.S. dollar. We've seen this big sell-off. It's reversing a little bit today. But what do you make of the sell-off so far in terms of market functioning? We throw around words like order, disorderly a lot. Where do we fall right now?
Yeah, I think it's been orderly, to be honest. And I think that's even more alarming because what it tells me is that people have accepted this fate that either the Trump administration wants a weaker dollar and not to fight them, or that in general, the fundamentals for growth here are dictating that the dollar should weaken just on that. All of that means that this is probably in the early innings still.
I mean, the concern obviously is that normally investors in times of trouble flock to the dollar. Normally investors in times of trouble flock to treasuries, being that it's the most riskless asset.
The full faith and credit of the United States government behind them.
So is the idea maybe treasuries are not so risk-free? That's why I'm willing to pay so much more for gold versus silver than I normally would be.
I agree with that. I think that is being all questioned now. It's not only, again, the worry of where the dollar hegemony is going, whether it's a reserve currency because our trade balances are going to change, but also our fiscal situation, whether we're going to actually be able to effectively lower our fiscal deficit. Now, we've seen a lot of Doge talk and nonsense there in some ways because we don't have a set number of how much cuts are actually occurring. But overall, also on the tax front, if we go into a recession or a downturn, there's going to be less tax revenue. So all of our fiscal deficit worries are not going away by any means. They're only increasing.
Well, Matt brought up the concept that maybe U.S. Treasuries aren't risk-free. We had a conversation with Victor Hagani of LTCM yesterday, who basically made that case that Treasuries are trading like there's some degree of credit risk. He might be alone in that. And he says that, of course, U.S. Treasuries are still way less risky than stocks. But still, there's a lot of volatility at the long end.
Hey, listen. He lived it.
Yeah.
So,
he knows what not risk-free means as a founder of long-term capital management.
Uniquely qualified
there. He's been in the middle of that storm. Anyways, Michael Ball, we thank you so very much. Brilliant analysis as always. Learn something new every time, like melting your copper gets you gold.
There you go.
Less than 12 minutes to the opening bell. Stick with us. We're going to start the trading day with Citi's Stuart Kaiser. This is Bloomberg Open Interest.
Well, the strategist who called an end to U.S. exceptionalism in February is out with a new warning. SocGen's head of asset allocation says that a rotation out of American assets will continue potentially for years if Trump maintains his trade policy, with the dollar and Treasury bonds losing appeal. Citi head of U.S. equity trading strategy, Stuart Kaiser, joins us at the desk. Stuart, first of all, great to see you.
Good to see you. Morning.
So let's talk about U.S. exceptionalism, because that has been the popular narrative. It's been the popular trade, too, if you take a look cross-asset, that basically the U.S. financial dominance is coming to an end. Where do you fall on that debate?
I mean, I think it depends how you measure U.S. exceptionalism. I think for the last 2 to 5 years, U.S. exceptionalism has been two key things. One has been we've been out fiscally spending most of the world, and the second is we have a lot of large cap growth and tech stocks that really don't exist in other indices. Clearly, both of those are being challenged, right? I mean, if you believe in the Doge efforts, we're going to kind of, dial back fiscal, and then the growth stocks, are clearly kind of under pressure right now. So I think tactically that's the case. How this kind of plays out over the next 6 to 12 months, we'll ultimately see. Clearly our economy is going to be impacted by tariffs. Is that going to be impacted more and worse than, let's say, Europe or China or others? I think that kind of remains to be seen.
It does look like President Trump is intent on putting tariffs on our trading partners, especially China. He wants to start and fight a trade war. He says trade wars are good and easy to win, right? With that in mind, can you really expect any kind of stability after 90 days? I mean, do you really expect any kind of stability from this administration next year or the year after seeing what they've done so far?
Well, I think China is a little bit of a separate case. I mean, I think what we're looking for is more successful trade negotiations with our key trading allies. And I'd put, Europe, India, Japan, South Korea, Australia into that category. I think if we see good progress there, that is good for markets, and I think that could be really supportive. China is a little bit of a special case because they use the term trade war as it refers to China. And I would not expect to see a huge rollback on China because the tariffs he put in place in 2018 did not get rolled back either. So I do think China's a little bit unique, but, what we would hope to see is progress in other areas. And I think the markets would probably take that well. To your point, though, I mean, tariffs are higher now than they were at the beginning of the year. And at the end of this year, they're probably going to be higher, still.
Substantially higher.
Yeah, potentially. Yeah, substantially,
compared to what we've
exactly.
been I want to talk about where people have been hiding. We've been talking about gold just a little earlier. This morning, gold hit 3,500. We have pared back since then, but it makes me wonder, to what extent is this as a haven trade starting to play out? I mean, what is the limit?
I mean, what the limit is, I'm not sure. I mean, I think our commodity strategists had a 3,500 target that they introduced less than a month ago, and we've gotten there already. So, clearly you can, kind of beat that to the upside, overshoot to the upside. I think if you look at what yesterday, how markets traded and were priced, you had TLT, which is long-term equity, long-term treasury volatility, and gold volatility, both significantly outperformed. They were actually up more than S&P 500 volatility in a 3% down day. So clearly people are either A, trying to hide in those assets, or B, viewing those assets as very sensitive to trade policy and inflation risks. And again, I would respect that. A couple weeks ago, our view was that gold volatility hadn't moved enough and that was a place to hide. It does kind of feel like people are trading gold, though, as as a dollar trade. I want to be short the dollar. I'm not sure what other currencies I can be long against that, so let me just kind of hide in gold. So I do think gold is a little bit of a haven. U.S. rates market, I think, is a little more up for debate whether that's a haven or whether that's kind of a directional trade.
Yeah, hiding out in TLT sounds hard to do at this exact moment, but let's take this conversation to the options market, because you do see people grabbing protection in derivatives right now. There was a great story on the Bloomberg terminal how if you look at Magnificent Seven's put to call ratio, that you're seeing a lot of demand for puts relative to calls right now. And as we head into really the heart of earnings season, we have Tesla kicking us off after the bell tonight. Is that the trade to do right now?
To hedge Mag 7?
Yeah.
Look, I think the reason people are hedging Mag 7 is because they still own it. You know, as much as people have backed out of that space, it is still kind of a core long position. So I do think you're seeing people, especially given the headlines we've seen on NVIDIA and in the chip space, you know, kind of hedge that. You know, if you take a step back on earnings, you've had about 50 companies report over the last month. Those that have either cut or withdrawn guidance have traded down 5% on earnings. Those that did not were up 1%. So clearly there's a huge focus this earnings season on how companies guide and if they guide. So, you know, why are you seeing people hedge? I think just for that reason. They're worried that in that space you are going to see, you know, headwinds to the earnings outlook. And as we've seen, that is not quote unquote priced. I think a lot of people say, is our tariffs priced? Is a recession priced? Is guidance down priced? The market is telling you it's not, because when we get new news in that area, those stocks sell off and the market sells off. So I think that's really what you're seeing is you've got a policy risk, you've got a positioning risk, and right now people are worried you also may have an earnings/CapEx risk. So you're seeing hedging in that space.
All right, these things take time. We're going to keep you with us today. Stuart Kaiser sticks with us through the opening bell. As we head into that, let's take a look at where futures are trading after the big drop that we had yesterday. Didn't close down so low. We were off 4% at one point and closed off just a little more than 2%. We're seeing the S&P off more than 1% right now. The Dow Jones Industrial Average, up more than 1%. Dow Jones Industrial Average up 427 points. The open on the other side of this break. This is Open Interest. We are moments away from the start of trading on this turnaround Tuesday. This is Bloomberg Open Interest. I'm Matt Miller. You are looking at futures climbing across the board. So S&P futures up more than 1%. NASDAQ futures up 1.3%. What do we have? Dow Jones futures. I like it. Katie, look at that. Up 450 basis points. And it matters. People are paying very close attention to the Dow because it has fallen from 45,000 and change down to 38. The opening bell at the New York Stock Exchange ringing at GE Vernova, and they're in a good mood, as they should be. Their stock is up 130% over the past 12 months. Down at the NASDAQ Stock Exchange, you've got people ringing the opening bell. They're not publicly traded, but they're owned by a company that's owned by IAC, and they're down about 43% over the past 5 years. Katie, what are the individual stocks you're watching as we bounce back a little bit from yesterday's drops?
Well, speaking of 43%, that's about how much Tesla is down year to date, and that's the setup heading into its report this afternoon. Remember, we know the company trying to navigate away from the brand damage that has been done by Elon Musk's work in the White House. And at least for right now, Sonali, the stock is up about 1.2%.
I got a down arrow for you, Katie. Northrop Grumman down more than 8.6% at the market open. They cut its earnings outlook for the year. Manufacturing costs rose due to a change in the production process.
All right, Verizon is another stock that we're watching right now. Lost more customers than expected in the last quarter, and probably more importantly to consumers watching, the CEO says if smart prices rise, and that's a pretty small if, consumers will absorb those costs. Smartphones. Did I say?
You said smart prices.
But smart prices.
Well,
Smartphone prices
over your brain
rise.
A little bit, isn't it?
I was what?
It's taking over the brain power a little bit.
Yeah.
Of smartphones. We talk to it every morning.
I was over my skis a little bit in terms of the script there. Let's bring back in Citi head of U.S. equity trading strategy, Stuart Kaiser. And Stuart, we were talking about earnings. We go into our morning meeting at 6 a.m. every day, and lately we're just waiting for the earnings calls because we know they're going to say, uncertainty, tariffs, and really bring down their outlook. So what do you expect in terms of earnings growth this year? 4 or 5 months ago, had we had this conversation, you would have said 14, 15% growth.
Yeah, it's much lower now. I mean, our U.S. equity strategists took down their EPS number to 255, and you're working off about a $245 base. So that cuts your EPS growth from like mid-teens to kind of mid-single digits. And, I think you probably have to argue there's downside risks, beyond that, because I don't think a lot of strategists at this point are fully factoring a potential recession. Not that that's our call, but I think that is kind of the risk to the downside. I think the question on this earnings season is what does management do? If you defend your numbers, you better have a very good reason, because I think there's going to be a lot of critical thinking of why you're able to do that. And if you pull, I think the question is, does that clean up your stock and allow the buy side to really engage with it? And then the third option is just to either say nothing or pull guidance totally. And there, I'm not sure investors are going to respond very well to no guidance. If you guide down, that's one thing. If you pull it and say you don't have enough visibility, I think that kind of opens you up to a lot of risk going into earnings season.
I've been the person on the show that has been pulling up constantly the year-to-date performance of the Magnificent Seven, and throughout the year, it's been getting more and more bleak. It's pretty crazy. You are looking at these companies starting to report this week. You have Tesla tonight. You have Alphabet, Google later this week. You have news on potentially Amazon, according to Wells Fargo, pulling back on data center leases. I mean, can this get any uglier?
I mean, that's a lot of red bars, so it's hard to get too much uglier. But, I mean, look, it can. I think the CapEx guidance is going to be key here. There's already a lot of pressure on that AI trade, starting from DeepSeek and then moving on to other headlines we've gotten, regarding China, chip exports and things like that. So, look, the focus for Meta, for Google, and for Amazon is going to be how committed are they to that CapEx spend for this year, and probably also what are they seeing for CapEx spend to next year? And if they were to really, dial that back, I think you will see another leg lower in that AI-exposed trade. And, to Katie's point earlier, I think that's why people are hedging. It may not be your most likely outcome, but it is a very severe outcome if it happens. And as we've seen the last month, severe outcomes, are not off the table.
Yeah, absolutely. They're the hot topic of conversation. So what do you do with all of that? I mean, I'm looking through your notes. You mentioned that, you're taking a look at what has lagged since April 2nd. When you boil down into the sector level, where are you finding maybe not opportunities, but at least places to hide out?
Yeah, I think growth stocks is an area where we think you can hide a little bit. If you look at the PE damage done to long growth, the average PE of long growth stocks is down almost 30% since mid-February. And I think after that happened, what you've seen in April in particular is those stocks starting to act defensive again. So coming into the year, tech and growth in particular, you had very high valuation and you had very long ownership. Both of those, while not completely fixed, have been addressed in a pretty significant way, and I think it's allowing people to kind of hang out there. So to the long side, I think growth stocks make sense, and I'm talking if you're like a 3-month type of investor. Tactically speaking, if you expect good headlines, I think you're just buying what's sold off the most because you're hoping for kind of a risk premium reversal. That's going to be weaker balance sheet stocks, it's going to be banks, and it's going to be semis. And again, that's not a fundamentally driven view. That's just I think I'm getting good headlines. What's been sold most might bounce. But our base case is still that lower is the path of least resistance, at least until you get down to around that 5,000 level on the S&P. And I think you just have to respect that that's kind of where the weight of the market is right now.
So you are the head of U.S. equity trading strategy. How many clients are calling you and saying, like, Stu, do you have the number for the guy who runs EMEA?
Look, it's a huge focus. I think that's been a focus all year. It's like, how durable is this rest of world outperformance relative to the U.S.? I think the risk for Europe here is that they've outperformed by so much, and they haven't really caught the tariff bug, quite yet. And so those negotiations with Europe on tariff are going to be immense. If that initial tariff announcement is worse than expected on Europe, then the degree of outperformance you've seen, I think, is under threat. Frankly, since April 2nd, the DAX, for instance, has done pretty poorly.
By the way, are you not considering the possibility that we become a closed economy and the rest of the world continues to trade with each other? Because Zero Hedge had a story yesterday, protectionism is good, and they were arguing for a completely closed U.S. economy.
That's where we are in the cycle.
Look, it's all possible. I think you have to ask your question, though, is trading with the U.S. with slightly higher tariffs worse or better than just being part of a global trade environment that excludes the biggest economy in the world? And I think the answer from the Trump administration would be no. Folks still want to have access, to the U.S. economy. If you're Europe and we tariff China and they start selling a lot of low-priced goods into your economy, what does that do to your economy? And is that an outcome you want? Because that is exactly the outcome that middle-class America has faced for the last 20 years that Trump believes he needs to resolve. I'm not endorsing that policy, but I think that's what's going on from a narrative perspective.
So he wants higher-priced smartphones, right? I mean, $1,000 is so cheap for an iPhone. I wish I could pay $5,000.
Speaking of smartphones, this morning, Verizon CEO, as you were talking about, saying that those smartphone prices can pass off to the consumer. Given that we're in the thick of earnings season, there's a lot to worry about, and part of that U.S. exceptionalism story is part of that big tech dominance. I want to play Matt Miller. Pull up a cool function on the terminal.
Nice.
I want to pull up SPLC for Google. This is the supply chain, but I want to look on the right side, not the left side this time. The right side is who they sell to.
Keep pulling out?
Yeah,
pull
out even more. Let's see what's happening on the right side here. So what we have here is Verizon, AT&T, T-Mobile as some of the largest players in the revenue space when it comes to what Google is selling to. If you're already hearing from Verizon and they're telling you consumers have to worry a little bit, and then Google is one of their biggest suppliers, how much do you have to worry here about if big tech starts to sputter, how much that impacts everybody else?
Look, I mean, I think that it also actually gets back to the CapEx discussion, which is who is that CapEx spent on? It ends up being kind of a little bit of a closed loop, right? You know, Amazon announces CapEx, that CapEx gets, funneled through semis companies, and you get this sort of positive feedback loop. Well, you can also have negative feedback loops. So I think that is what people are worried about going into earnings, is if they pull back on CapEx, it creates kind of a domino effect, that impacts spending across the entire complex. So again, not a forecast, but I think that is what people are worried about going into earnings, which is if you had this sort of positive feedback loop going up, do you get a negative feedback loop coming down? And if so, then, a lot of the outperformance you've seen over the last 2+ years is at risk. Frankly, Mag 7 has given up 6 months of relative outperformance against the S&P 493. So there's already been a significant amount of damage done. The question going into earnings is there another leg behind that, I think?
Yeah, we'll find out and hope to speak to you soon on that topic as we get into earnings season. That is Stuart Kaiser of Citi. Thank you for your time this morning. Meanwhile, let's take a look under the hood because 9 minutes into the session, some pretty interesting movers on our radar. I want to pull up Kimberly-Clark. It lowered its profit expectations due to tariff costs. The stock is down almost 3%. Interesting move given that obviously they make consumer staples. You also have 3M maintaining its outlook, noting that tariffs add new risk to turnaround plans, but the stock is up nearly 5%. And then Boeing, we've been keeping an eye on, selling part of its digital aviation unit to Thoma Bravo for nearly $11 billion. The turnaround continues over at Boeing. Now coming up, Verizon in the red after losing more subscribers than expected. We'll take a dive into the wireless giant's first quarter next. This is Open Interest. Welcome back to Open Interest. A check on these markets with the S&P 500 at session highs right now, up 1.3%. It's big tech that's leading that index higher, and you can see that expressed in the NASDAQ 100. You have Tesla, Nvidia, Apple rallying today, but it's actually the small caps, Matt Miller, that are outperforming. So I have the Russell 2000 up here, currently up about 1.8%. We're going to keep a close eye on this entire market, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, United Health getting downgraded over at HSBC. The analyst says that the company's profit warning caught him and the rest of Wall Street off guard. You can see the stock deciding what to do today. Next up, we have Macy's getting downgraded over at Goldman Sachs because of rising macro uncertainty and cyclical risk. And finally, we have Kraft Heinz getting downgraded over at Bernstein. The analyst says the company is seeing volume declines in its brands, including Lunchables, Kraft Mac and Cheese, Capri Sun, and Oscar Mayer.
All right, let's get a check on Verizon as well. The stock is falling after the wireless giant recorded a loss of nearly 300,000 monthly phone subscribers. And the CEO says consumers will absorb any price increases for smartphones. For more, we're joined by Bloomberg Intelligence senior telecom analyst John Butler. So I guess, for the stockholders, the first concern is the loss of customers. What's going on there, John? Why are they losing customers?
So it happened early in the quarter, Matt, and that's the good news. What Verizon is doing is they're raising rates on some of their older, what they call legacy plans, not the latest unlimited plans, but those people like me, by the way, that have these older plans are seeing a price increase, and that's going to help them deliver on their growth promises for the year in terms of wireless service revenue. But it cost them in terms of people leaving Verizon when some people leaving Verizon when those price hikes came through. One thing they downplayed, but I think it was a big issue during the quarter, is it's a very promotional market. And I think what happened is we had some holiday promotions that spilled over into January and February, and Verizon is sort of a premium plan and premium priced wireless brand suffered from that carryover.
So if Verizon lost some customers, where do they go ultimately? And does it mean that Verizon has to react given that promotional environment that you've been talking about?
So that is a great question, and one thing that I think they should do, which is they should be a little bit more promotional, because the market here is maturing. The battle for subscribers quarter in and quarter out is getting more intense. And to answer your initial question, T-Mobile hasn't reported yet, but I wouldn't be surprised to see them emerge once again as the winner this quarter in terms of total, what they call net phone additions, those smartphone users that jump brands, and T-Mobile tends to win during periods of promotion when you get a high degree of what they call switching activity.
John, I also want to get your perspective on something that was named for a reason why you saw fewer subscribers from Verizon, and that is less spending by government agencies. We know that the government in general, led by Elon Musk, has been trying to slim down, and I'm wondering how you think that this factored into the results we saw this morning from Verizon.
So the easy answer is it really didn't impact them to any great degree. It was visible in the numbers, and so they addressed it. What they alluded to were the Doge cuts and how they had an impact. And when you get seat loss like that, obviously, if users had a government phone, those contracts get terminated as those people leave. So that's a trend that may continue, Katie, but I don't think it's going to be anything that's going to impact them in a big way going forward.
By the way, let me ask quickly, John, because I have a viewer writing about financing phones. If iPhone prices went from $1,000 or $1,500 to $2,000 or $3,000, does that matter to consumers since most of us pay for them monthly anyway?
No, I was just going to answer the question in that manner, Matt. I think even with a meaningful price increase, most people are financing their phones over 36 months. And so net, yes, they see a price increase, but they're not eating that, let's call it $1,000 increase up front. It's amortized over a 3-year period, and so much less painful.
I'll start taking 5-year or 7-year loans for our phones. John Butler of Bloomberg Intelligence, thanks very much for joining us. Now coming up, it's a busy day for deals from Boeing to Nomura. We'll have a roundup next in today's Wall Street Beat. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We are seeing a rebound on the S&P, not recovering the 2.4% that we lost yesterday, or the 16% that we've lost this year. But we're up 1.4% there on the NASDAQ, up 1.7% as tech stocks put up bigger gains. And then the Russell 2000, the small caps, are the biggest gainer for those optimistic investors out there. In terms of the individual stocks that are moving, we're watching Nvidia up 2% just because of the weight. Tesla up 3.5%. It's coming out with earnings after the bell, and we expect to hear some fireworks from Elon Musk. Lockheed Martin and Northrop Grumman both losing, although Northrop Grumman disappointing with earnings, getting absolutely decimated, and Boeing up 1% after announcing it'll sell a unit for $11 billion to Thoma Bravo. Sonali?
Private equity in play. And that brings us to the Wall Street beat. Earlier this hour, Boeing announced that it will sell portions of its digital aviation unit to Thoma Bravo, as you've been saying, for nearly $11 billion. That is $11 billion in cash. For more on this deal and more M&A news, shockingly, that we're seeing this week, we are joined by Bloomberg's managing editor for U.S. deals, Liana Baker, our resident scoopster. And so, you think about this Boeing deal. You guys have earlier reported that it was happening. Thoma Bravo on a tear. Are they the only ones?
So they prevailed over other PE bidders, as we've reported, and there was also strategics circling this asset for Boeing, but clearly Thoma Bravo got this to the finish line. And as you mentioned, they're paying about over $10 billion all cash for this. And it's a way for Boeing to, pay down debt and try to fund their turnaround after all those, crises that have happened.
So we have Boeing, Thoma Bravo out today. I also want to talk about the news we got from Nomura yesterday, basically acquiring Macquarie. I never quite know how to say them, but biggest deal since Nomura bought Lehman Brothers. And it seems like it's a pretty big bet that U.S. exceptionalism maybe isn't going away anytime soon.
So it's funny because it's a Japanese acquirer doing outbound M&A to Australia, but it's a bet on the U.S. market.
Yeah.
And Nomura didn't pay a lot for Lehman Brothers back in the day, but they're paying over $1 billion for this asset. And it is interesting to see financial services deals make a comeback. Maybe these aren't super affected by tariffs, but we have seen other deals in payments and banks. That's an area to watch for sure.
It's Macquarie.
Macquarie.
I
Just
know
like
Macquarie.
I'm going to stare in the mirror and say that to myself.
Like John Macquarie.
Yeah.
Macquarie.
Macquarie.
All right.
Macquarie.
We got more, though.
Yeah, there were 3 deals. Wait, we did Nomura, we did
Barrick.
Thoma Bravo.
Barrick
So
Gold.
it's funny,
Yeah.
we've talked about the financial crisis or Lehman. So John Paulson was actually
We haven't
involved in
seen
this
that in
other
so
deal.
long.
So we hopped on the phone with him yesterday. He's actually putting $600 million or $800 million into a big mine in Alaska. So he's a big backer of Nova Gold, and they're buying out the stake which Barrick owns in this Donlin Gold project. And apparently Barrick is changing their name, I'm sure you guys know, away from Barrick Gold to Barrick Mining. This is part of that trend.
Then they have a lot of copper exposure as well. Fun fact. Now, does this?
And what's the deal with copper? You say you can melt copper and get gold?
and
We learned
extract
that
some
from
gold.
Stuart Kaiser. Yeah, if you're really desperate to get your hands on some gold, just find some copper.
Does this
not know
mean that there's actually a lot more coming? We heard from John Gray over at Blackstone. They said this is a moment to take advantage of. We saw KKR pull out their COVID-era playbook. Are sponsors going to lead the deal comeback?
So we did see a pause with all the tariff drama, but it definitely was a takeover Tuesday today after a long weekend where it might have been slow with the holiday. But we're definitely looking at pockets of M&A. I mentioned financial services are busy. Private equity deals backed by private credit are very popular right now, but definitely there are things in the works and we're very busy.
Are people getting discount prices? Is now a time when people who had cash, dry powder as it were, going into the market and finding distressed deals?
We're trying to figure out, is it a buyer's market or a seller's market? I'd say Nomura today, if you look at the multiple on that deal, they feel like they were getting a good valuation there.
All right, Liana, great roundup as always. Obviously, you're a very busy woman right now in this deals environment. That is Liana Baker. Meanwhile, let's check on these markets right now. It's another day of pretty low volume, but this time into buying. You can see the S&P 500 up about 1.4%. We're close to session highs. We were higher by about 1.5% earlier. A lot of that enthusiasm is making itself known in big tech, specifically ahead of a big day later today with Tesla taking the earnings stage. The NASDAQ 100 up about 1.6%. And the small caps also up there, Matt. I don't know what the Dow is doing, but I would imagine
it's been a while since you've mentioned them.
Well,
they're coming back a little bit.
A little bit.
Baby bit.
The Dow is up over 500 points, NBD.
Whatever that means.
But it's really the small companies that matter. Did you guys see? I thought it was awesome. Torsten Slok usually puts out like one graph, one
big
paragraph, one thing. And on Friday, he put this prediction out, 90% chance of a VTRR. A voluntary trade reset recession.
Yeah.
And he pointed out that small companies, so less than 500 employees, are worth 80% of the hiring and 85% of the CapEx.
I believe it.
And they get hit the hardest.
Driven the American
Friday
economy.
was a holiday, so I did miss that one. But
I'll forward it to you. Coming up in the next hour, Northern Trust Asset Management CIO Anwiti Bahuguna. Jan Hatzius of Goldman Sachs joins us. And then the points guy, the very tall Brian Kelly. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, the IMF cuts its global growth forecast, saying downside risks dominate. This hour, we're going to get the outlook from Goldman's chief economist, Jan Hatzius.
Meanwhile, earnings season kicks into high gear with Tesla leading the charge today after the bell.
Plus, travel cutbacks. The U.S. economy is set to lose billions of dollars this year as foreign tourists stay away. We'll discuss with the points guy himself. But let's go check on these markets right now. The S&P 500 up 1.5% as we head into a very heavy earnings week. As Matt said, Tesla kicks us off after the bell today. We do have the 10-year Treasury yield, a reversal of what we saw yesterday with that Sell America theme. A little bit of buying coming back into the U.S. bond market, sending yields lower by about 3 basis points, and people aren't grabbing for gold as much right now. It's still positive. It's still near session highs, but a little bit of a relief when it comes to that Haven rally, which maybe is a good sign, Matt Miller.
Wow, $3,400 for one troy ounce of gold.
$3,500, yeah.
That is concerning. I would say that's concerning, right?
You're scared.
Unless you bought it early last year.
No, I'm just saying the price action to me means people are stocking up on gold, guns, and water. Like, people are worried about things.
Selling the dollar.
Let's talk to Anwiti Bahuguna right now about this. She's Northern Trust Asset Management's CIO of Global Asset Allocation. And I want to kick off with something we got in your notes, Anwiti. While we've downgraded our macro outlook for the U.S. vis-a-vis other regions, we do not want to significantly reduce U.S. equity exposure after these moves. So you're holding on.
We're holding on a little bit, primarily because the market, with a 20% correction in S&P 500 from the peak, and almost 25 and 27 in small caps NASDAQ, has priced in a lot of the bad news already. And at this point, we are looking for more stabilization than a surge in equities per se, even though today they're behaving as if everything's normal. I think we're in a period of extreme uncertainty where one should not react too much to daily movements.
Well, I want to dig into that theme a little bit more when it comes to the Sell America trade. I was talking to the CEO of Vanguard in the past few days, and he made the point that if you take a look at the underlying innovation in the American economy, the kind of growth that we've had for decades in the United States, that's not going to go away overnight or over the course of a couple weeks. And I mean, when you look around the globe, obviously you don't have the American tech giants there. You don't have the kind of industries that we've honed in America. And as an investor, I wonder how you approach that.
Right, and that's an excellent point. I think the longer-term themes of AI, energy transition, demographics, all those longer-term strategic themes are still very much alive. But on the margin, Katie, we are seeing the deep seek in China, the resurgence of fiscal spending in Europe. Those themes are making people question just the pile into U.S. tech stock trade that was the norm for the past 2 or 3 years. And we're really just seeing some air coming out of that tech bubble, essentially, if we should call it that. And people wondering that, is there room to be in European stocks? Is there room to be in Japanese stocks, in EM? All those areas where you already have a valuation cushion, which you don't in the U.S. stocks.
One of the places that you firmly see the Sell America trade is in the dollar.
Yes.
And it is getting pretty incredible in terms of how much people are talking about the dollar in terms of decoupling versus other assets in the rest of the world, in terms of the significance of the dollar as a reserve currency. What do you make of the ripple effects of that type of a sell-off?
Right, so that's a question we're getting quite frequently from our clients, actually, Sonali, because our clients, Northern Trust Wealth Management, enormously invested in U.S. stocks. And for the first time, it's not that we're seeing a huge sell-off from external holders of U.S. stocks. We're actually seeing interest for international stocks from the U.S. asset owners. In other words, it's not clear to me that there is a danger to losing the reserve currency status per se, but there are massive flows that are changing now. Instead of flows from international coming to the U.S., we're seeing flows from U.S. going abroad. And that flow trade itself can lead to this dollar weakness that you're seeing.
What are your clients most interested internationally, and how are they making that trade? Are they buying ETFs of European stocks? Are they looking at, Asia, What's hot?
Sure. So we had been pounding the table that EM, a lot of bad news had been priced into EM, Matt, even last year. So we had gone overweight EM last year. We were still underweight European stocks, mainly because there wasn't any sort of catalyst to make us think something structurally changing in those stocks to give it that oomph that will attract investors from abroad. And so with the fiscal news, we are finally seeing interest in European stocks also. And I always, when I talk to our clients, say that when you're beginning to inch up on your risk taking, you don't jump really necessarily from US to EM. Europe is always the sort of medium-term
There's a
step.
stepping stone.
There's a step. You leg into risk. And so a lot of interest in developed ex-US stocks we are seeing from our clients. And I would say that, we are a shop that's primed for this environment. We have a huge business in the quantitative, structured way of managing stocks. So we focus on quality stocks with low volatility, and those are the things that actually are outperforming. Even in this sell-off map, we've seen positive returns.
But what vehicle do you use? Because I used to, for a brief moment, I co-anchored an ETF show with Katie before Scarlet Fu unceremoniously kicked me off.
We fired Matt.
So yes, FlexShares is our brand. We have amazing lineup of ETFs, one called QLV, QDF, these, and then international versions of these, which are really good in this environment where you still want to leg into risk but play defense at the same time.
Well, I'm glad that we're talking about ETFs for a lot of reasons, but also because if you take a look at the flows, I mean, it's gold ETFs. It's these short duration cash-like ETFs that are really sucking up all the money. You're still seeing some love for, S&P 500 tracking funds, but there's a lot of interest in just safety plays right now. And the conversation a couple months ago was how do you get investors out of cash? But I mean, it's very clear right now that cash is a magnet for a lot of these folks.
Absolutely. So we are asking clients to sort of maintain an absolute benchmark allocation to cash. The other area where we're seeing a lot of interest for the first time is actually global bonds. And that's a play on sort of the dollar movement also. With dollar underperforming, folks are really interested now in euro bonds, in yen, in Swissy. These areas are, again, outperforming, and we're seeing flows into essentially your defense plays.
Anwiti Bahuguna of Northern Trust Asset Management, we thank you so much for joining us here on set. As we've been saying, complicated market to digest has only gotten more complicated throughout the year. Let's take a look at stocks now moving under the hood this hour. We're looking at Northrop Grumman cutting its earnings outlook for the year. Now down more than 12% after the market has opened. That has gotten a little worse. Manufacturing costs have been rising due to a change in the production process. We're looking at First Solar surging after the U.S. set new duties on solar imports from countries.
3,000%.
Yeah.
Not just new duties.
Yes, fair enough. But the stock now up only 13%, but significant given that what we've seen for that stock throughout the year. And we're watching GE Aerospace higher after earnings and news that CEO Larry Culp spoke with the president to advocate for a tariff-free regime in the aerospace supply chain. Maybe.
That probably went over well.
Maybe they are one of those sectors that can get that rare exception.
Tariff-free is something that the president loves, right?
I know.
Zero tariffs is what he's all about.
Yeah, as we know, that is
sarcasm.
That is hopium.
Wishful thinking.
Yeah.
Hopium is a good word. Anyways, coming up, Jan Hatzius, Goldman Sachs chief economist. He's going to join us to parse through all of this next. This is Bloomberg Open Interest.
Let's get now to high interest, a look at what's making headlines around the world. The Harvard versus Trump showdown is heating up. The elite university is suing the U.S. government for freezing billions of dollars in federal funding. Harvard claims the administration's demands for changes to its governance, discipline, and hiring policies are unconstitutional. The lawsuit claims the funding freeze violates its First Amendment guarantee of free speech. And across the Atlantic, Emmanuel Macron is exploring the possibility of dissolving parliament and holding snap elections as soon as this fall. Macron has consulted figures in his inner circle in recent weeks regarding his options. his return to international prominence has helped boost the French president's popularity at home. And the International Monetary Fund is slashing its forecast for world growth for this year and next, warning the outlook could deteriorate further as President Trump's tariffs sparked a global trade war. The IMF's chief economist addressed the downside risks earlier.
Beyond the abrupt increase in tariffs, the surge in policy uncertainty is a major driver of the economic outlook. If sustained, the increase in trade tensions and uncertainty will slow global growth significantly.
The downgrades add weight to similar warnings from several Wall Street banks, including Goldman Sachs.
Perfect segue, because joining us now for more, Goldman Sachs chief economist Jan Hatzius. You know, you have the IMF for the U.S. alone reducing growth and increasing inflation expectations. You have the president of the United States really pushing the Federal Reserve to cut interest rates and threatening here Jay Powell's job. Do you think the Fed does, in fact, have room to cut interest rates? Is there a case for that to happen, given the inflation concerns?
It's complicated because clearly the growth outlook has deteriorated very significantly on the back of these tariff announcements. And we've downgraded it by more than the IMF has. We're looking for only really barely positive growth in 2025, 0.5% fourth quarter to fourth quarter. But at the same time, the inflation outlook's also deteriorated, and we're probably going to get back to the mid threes, if not higher, for core inflation. So I think the Fed's going to probably take a wait and see attitude, at least for the next meeting, because I think at this point it's unclear what is going to win out. What are the drivers of the ultimate decision? I think number one, do we see a significant deterioration in the labor market, a significant increase in unemployment? That would make cuts a lot more likely. And then number two, what do we learn about inflation expectations? Do they stay anchored? And I think if you see deterioration in the labor market and pretty good inflation expectations numbers, then I would expect some cuts before too long. We have three cuts, 25 basis points in June, July, September, but that's going to really depend on the economic data.
Right. So there could be a case for cuts, but it sounds like it doesn't quite exist yet. I want to get your thoughts, Jan, on another story that's been developing over the past week or so, and that is that Trump reportedly talking in private about options, what it would look like if he could remove Jerome Powell from Federal Reserve chairmanship. And I'm curious what you think that the reactions specifically in the Treasury market would look like were that to happen.
Well, I think we've seen it in the last couple of weeks when that has come up last week and then again over the weekend and yesterday. We have seen significant tightening in financial conditions with increases in bond yields and declines in equity prices and also weakness in the dollar. But from net, it has tightened our financial conditions index whenever that has come up. And so I think that gives you sort of a foretaste of what would happen if we really did go down this road. There are a lot of legal issues around this, and I'm of course not a lawyer, so I don't know what the ultimate adjudication would be, but it is clearly something that has had a significant impact on financial markets.
I want to ask you about Torsten Slok's forecast, 90% chances of what he calls a VTRR, a virtual trade reset recession. He notes that 80% of U.S. employment, 85% of CapEx comes from small businesses, and they have a much tougher time dealing with these tariffs. He says expect to see ships hit offshore, orders canceled, and well-run general retailers file for bankruptcy. Why aren't you as concerned as Apollo's economist?
Well, 90% is a very confident view on almost any outcome. I don't know if that refers to the standard definition of a recession, which is really the National Bureau of Economic Research determination. On that basis, we're at 45% for the next 12 months, which is definitely a high risk of recession. It's practically a toss-up. But I think the questions at the moment are, do we see a weakening of the hard data that is similar to what we've seen in the soft data? What's going to happen to the average tariff rate? And I think the pullback that we saw on April 9th does give us more of a chance of avoiding recession. And how big of a tightening in financial conditions do we see? There was a very rapid tightening between April 2nd and April 9th. Some of that has unwound. So it's definitely a significant growth drag. But whether it's a recession, I think it's a little too early to tell.
But can I just to double down on Sonali's first question then, why doesn't Jerome Powell cut rates now? If the soft data looks this bad, don't you want to stop it from solidifying into really bad hard data? Wouldn't a rate cut, a preeminent rate cut now, be the right move from the Fed?
That would be the argument in favor of a rate cut. The argument against would be that you also wouldn't want the very likely increase in inflation to harden into second round effects and ongoing higher inflation. That's the other side of the mandate. And I think at this point, the Fed is not going to be preemptive, but probably more reactive because they need answers to those questions.
Yeah, and we were speaking just a day ago to Claudia Sahm, and one point she seemed to make here was that if the Fed does cut interest rates here, does it look like political pressure? The issue that might be being created right now with the president's pressure on the Federal Reserve is politicization of the Fed, therefore the Fed's credibility. Do you think that this has the potential to create some crisis of confidence, frankly, in an institution that has been the backstop of this market for now, you could argue, the better part of a decade, at least?
Well, it certainly raises risks. I think the way to address those risks, if you're sitting in the FOMC, is to really be very clear that they're focused on the data and take into account what's happening in terms of the growth outlook and the labor market, but also look at the inflation outlook. I think, you don't want to cut because of political pressure, but at the same time, you also don't want to, refuse to recognize reality. If the way that the outlook breaks is that we see, a really significant deterioration in the labor market, then I think they should respond to that, and I think they will respond to that.
Let's talk a little bit more about Fed independence, because let's say that Jerome Powell stays on for the full length of his term, May 2026. But the genie's out of the bottle here, Jan. We know that political pressure exists, even if Trump doesn't take the ultimate step of removing Jerome Powell. And I wonder, when we get that next Trump appointee to run the Federal Reserve, what does it look like when you think about the board holistically? Is it possible that we see more dysfunction, more dissents when you think about the future of the Fed?
Well, I wouldn't call dissents dysfunction. I think it's actually quite normal to disagree, and we've had dissents over the years. And if you look at other central banks outside the U.S., it's actually much more common to have dissents, and I don't think there's anything wrong with it. So I don't worry about as much. Now, we of course have to look at how the Board of Governors evolves. And of course, there's also the Reserve Bank presidents. The FOMC is 7 governors and at any time 5 Reserve Bank presidents. So it is an institution that has quite a lot of institutional stability, even in an environment where the president gets to appoint a new chair and new governors. But it takes quite a long time. So I think there is there are some significant safeguards built into the system, and I certainly don't worry about dissents very much.
Yeah, and I spent a lot of my time, I started my career covering investment banks here, so the restructuring advisors are the ones that I'm calling the most these days. As an economist, how do you see the economy weakening? Where are you sharpening your pencils the most to see that fall off the cliff that we're standing on?
Well, in terms of sectors of the economy, I think you want to look at, number one, what's happening to consumer spending as real incomes decline, as prices rise, and that eats into real income on the back of the tariffs. I think that's going to happen over the next few months. And then number two, business investment, I think you're particularly going to be focused on the uncertainty effects, the potential for firms to just wait it out until they have more clarity. So high-frequency capital spending indicators are going to be helpful as well. I think there you probably do want to focus pretty closely on surveys of capital spending intentions because the hard data are very lagged and you're not going to learn in time what's going on. But I think those are really the two areas that are probably most important. Obviously, the trade data are going to be important, but they're going to be enormously volatile because of pull-forward effects and then changes in trade flows. But for the domestic economy, it's really consumption and capex.
Jan, great to get some time with you. Really appreciate you spending it with us here on Open Interest. Jan Hatzius there of Goldman Sachs. This is Bloomberg.
Well, an unintended consequence of the Trump tariffs is beginning to take shape. The latest data from the International Trade Administration shows a nearly 10% decline in U.S. tourism in March. That's a trend that could cost the U.S. billions of dollars should it continue. For more, we're joined now by Brian Kelly, the Points Guy founder and now an author. His first book, How to Win at Travel, is out now. Brian, great to see you in person.
Yeah, thanks for having me.
So let's start there. We had the CEO of Air France on with us a couple weeks ago, and he said that he wasn't seeing any pullback in demand to come to U.S. shores. But
he was being nice.
He was potentially being
kind to us. Well, the data, we just got the March data, and Western Europeans, those really rich tourists that spend a lot in retail, dropped 17% in March over last year. So there is and this, is clearly linked. There's no other real major issues that would kind of push Europeans away from coming to the U.S. And unfortunately, it's not just tariffs. I think just the overall immigration policy. Just this past week, we saw 2 German backpackers get declined from entering Hawaii. They were detained, strip searched, and sent away. They made the mistake of saying they do remote work when they travel, which is a no-no. You don't want to tell on a tourist visa that, oh no, I'm going to do remote work in the U.S. But these stories are going viral. I know a lot of people who have destination weddings that are scrapping them, So I think the tariffs play a role, but I also think our country's immigration overall policies are giving, foreigners pause.
For sure. I've heard a lot of the same anecdotal, people getting taken down by ICE and then put in jail for 24 hours, even though they're, teaching at private schools here. So, but my question is, if they're not coming to the U.S., especially the tourists, obviously if you're teaching here or if you've got consulting work, you're going to come here. The tourists, where are they going instead?
Well, I can tell you, I was just in Dubai, and that is, it was the #1 tourist destination last year. You see global visitors. It's safe. There's so many things to do, family friendly. I was in Thailand last couple weeks. Korea, Asia's back. I think travelers, especially those premium travelers, are now not so worried about the COVID restrictions. All those countries are really open and really affordable once you get there. So. The U.S., we have competition out there. We're not the only country that offers a lot to these really, premium travelers, the ones that every country wants.
I just want to harp on this idea for a moment here, because it's not even just foreigners coming to the U.S. that are worried about the immigration policies here. It is people who do live here that were not born here as well. How much of that fear exists for U.S. Folks right now, people in the U.S. that were not born here that might want to travel abroad, that are worried about their status as a citizen, that don't want to travel abroad?
I think there's a lot. It's hard to find those numbers. Anecdotally speaking to people, that wedding I was talking about, my friends were going to get married in Colombia because it's much cheaper, but there was just too much anxiety around, even the bride being able to come back into the country. At the end of the day, if you are not a U.S. citizen, no one is guaranteed entry into the United States. And they make that very clear, and Customs and Border Patrol agents have full authority to allow you in, even if you're on a visa. Secretary of State Marco Rubio said very openly, you have nothing to worry about unless you're here to protest and do other things. So what does that mean? If you've done any social media, you should assume the government has access to that. So, I think a lot of people are starting to realize that. And, I've read reports of attorneys coming back and border agents asking to get access to their client, attorney-client privilege. Right. So I think that there's just a lot of Americans and foreigners are like, as we figure out what are the new policies, no one wants to be a guinea pig when coming home from a trip to their home country.
Right, and like you said, it's starting to show up in the data. Let's talk a little bit more about American travelers, because the international trend, foreigners coming to the U.S., that is taking shape. But are we seeing any change in behavior when it comes to American travelers going abroad?
We are seeing a softening, and the airlines have noted this, like a 3 to 4%. They're planning for a slow decline later this year, but those premium travelers, and this is where all the airlines are making money. This is why we're seeing Frontier adding first class to their planes later this year. Those core premium travelers who are paying for those lie-flat business, apparently they are still booking this summer. They're going to Europe. They're going on safari in South Africa, those big multi-generational trips. I think it's on the lower end of the spectrum, economy, and that's where they're starting to trim back the amount of flights they have to destinations. Last year, the story was the airlines couldn't get enough capacity. They couldn't get enough airplanes into the sky. And this year now, we're just seeing, Chinese airlines are turning back Boeing airplanes that they've been waiting years for due to the tariffs. So it's a very interesting time of a lot of pulls and takes.
Well, we do see fuel prices coming down, and that's one of the biggest costs for airlines, right? Next to labor. Are ticket prices stable?
Ticket prices are cooling off a little bit. We're not seeing that rise, but ticket prices are really not where it's at these days. It's all about taxes, and fees on these award tickets and loyalty. Loyalty is what's driving the airline sector and hotel to a certain extent. The credit card companies are offering huge sign-up bonuses. Right now, the Chase Sapphire Preferred, a $95 a year card, has a 100,000-point sign-up bonus, which we haven't seen since the deep days of the pandemic. So.
Although that means less and less, Brian, because these companies are working at making these policies as confusing as possible, right? That's one of their main goals.
Well, in terms of inflation, devaluing the points, I would agree that in general, the airlines are charging more, but there's still tons of ways to get value. And at a minimum, that 100,000 points is $1,250 you can redeem for any flight or hotel. That's pretty incredible. In the U.S., you can get one credit card that's $95 and get over $1,200 in value. So I would urge consumers, as we see prices stabilize a little bit, but people are concerned and want to, safeguard their cash, is lean more into loyalty, because there are still huge deals out there.
So, we were talking about your book. First-time author here, and of course, you know a lot about how to win at this travel industry. Credit cards are, and a really important part of that. To Matt's point, you are seeing credit card balances for Americans at all-time highs. So how much more can people really be taking on, reward or no reward, right? I mean, can these companies keep on offering these discounts, and will it work?
Yeah, and I want to be extraordinarily clear, and I am in my book. If you're paying interest, sometimes it's a 30% APR, the points you're earning are worth nothing. You're not coming out ahead. So the key to winning at the points game is paying your bills off in full every month. But yeah, there are alarming trends about, we are a country that runs on credit and debt, and for better or worse, there are alarming signs there. But for business travelers, those who were going to pay for something in cash anyway, not only you're doing yourself a disservice by paying with debit or even wiring. If you've got a villa you're going to with your family, even if you have to pay the 3% fee to get your triple points on your Sapphire card, do it, because you get protections as well. You show up after you wire money to a fraudulent villa, you're not getting it back. So I put everything on credit cards, not just for the points, but also for the protections, because when anything goes wrong, you pick up the phone, you call Chase or Amex.
There.
Yeah, and that is a lifesaver when you need it. Or even purchase protection. I have a 2-year-old who drew all over a chair, and Capital One refunded me because of vandalism. I swear.
That's awesome.
There you go. Brian Kelly, we have to leave it there. Great to have you on set. Some alarming trends underway, but some actionable tips as well. That is Brian Kelly. He is the founder of The Points Guy. Meanwhile, let's get a check on these markets right now with the S&P 500 absolutely ripping right now after a pretty down day yesterday, but currently up about 1.7%. We have a nice cross-asset look here. You can see that a bid is coming back into the bond market, currently down about 2 basis points on your 10-year Treasury yield. Ignore the percent. We don't quote bonds in percent terms. But then you take a look at the dollar index, up about 0.1%. That Sell America trade fading right now. You also have gold catching a bid. But stocks, obviously in focus, Matt Miller, because we are very much in earnings season.
It's so fun to see the 10-year yield down 0.5%.
Yeah,
I can't wrap my head around that. But That's why we don't normally show it that way. Major theme of corporate earnings is obviously has been tariff uncertainty. Kimberly-Clark, for example, is cutting its outlook, and the CEO says the current environment will now mean greater costs across our global supply chain versus expectations at the beginning of the year. Well, that's not uncertainty. That's pretty certain. Let's bring in Bloomberg's Red Brown. There was some real uncertainty in these earnings calls, but the bottom line is prices are going to go higher.
I mean, that's what we're hearing from some companies that are especially exposed to consumers, such as Kimberly-Clark, right? So they have such a broad supply chain, getting a lot of their materials, their inputs from China and elsewhere, and then also they have a pretty significant amount of their facilities are in places like Mexico. So they're getting hit at different places along the supply chain, and that's, I think, why we're hearing a company like Kimberly-Clark kind of doing kind of radical transparency with some of the details. We've seen different strategies throughout the earnings season so far about how to handle the uncertainty, how to communicate that. Kimberly-Clark has been taking the approach today, this morning, of saying, this is what the impacts that we're going to see, and this is maybe worst case scenario, and then kind of deal with it from there.
Yeah, let's take a look at some more of that commentary. We've been pulling them out from all the earnings calls. And to your point, some of it is clear that prices will go higher. General Electric, for example, heightened tariffs will result in additional costs for us and our supply chain. RTX tried to size up the impact of tariffs for the remainder of the year if they were to stay. So calculations being made, the worst case scenarios, right? So all in all, how much of it is floating down to the bottom line already?
I mean, it's kind of difficult to say, right? We had 3M come out today and saying, like, you know, we're giving you a sensitivity analysis, they're calling it, of here's what our business is still expecting to do well as we predicted in the beginning of the year. We're executing best we can, but there is this level of uncertainty. We don't know how much is going to go to the bottom of the line. Yes, we know prices are going to go up, but a lot of the times they're also kind of caveating that saying if things stay as they are. And that's the big question mark, right? Like, are things going to stay how they're going to? Nobody really knows.
Right. It's hard to trust any numbers too much right now because it's so uncertain. And that's why you have companies coming out with different scenario plans. That is an extreme zoom. And let's talk about Verizon, though, because you do have some companies that are a little bit more insulated from the tariffs. Verizon, not that its stock is doing so great today. It did have a pretty significant miss on subscribers, but the company did say it was well positioned to handle some of these trade policies.
Yeah, this is another strategy that I think we've seen kind of appearing, which is almost like a shrug from the companies, from management, just saying, like, we're going to keep going about our business as usual. This isn't really something that we need to worry about. We thought we would hear kind of something similar from the defense stocks for the last few weeks. That's been an area where everyone's been pointing to as potentially insulated from some of these things. But we had some defense stocks coming out, and especially when it comes to the China tariffs around rare earth metals, things like that could complicate their businesses. So, no one is immune, but we do see people like Verizon just, doing their best to reassure people that, we're okay.
Red, I know you go on Bloomberg Business Week all the time, but this is your first time on Open Interest.
Well, it's my second. It was Open Interest. I think so. Yeah.
All right, so we'll have you back. Second time
I passed the test
in the TV studio. Red Brown there, running through some of the earnings he covers for us on the other side of the newsroom. Coming up, Tesla reports results after the bell. Red's going to pay very close attention to that, and we're going to speak with Sheppard of Cantor Fitzgerald next about what he expects and what he's looking for on the call. This is Open Interest. As we've been telling you, Tesla is set to report its latest results after the bell today. Investors are feeling a little bit of uncertainty over Elon Musk's role with the government and the company's plans for lower-cost cars. Joining us now with a preview of what to expect, or what he's looking for, really, is Cantor Fitzgerald, senior equity analyst Sheppard. Great to have you on the show. Thanks so much for coming on set with us. What are you looking for from Elon Musk? What do you want to hear the CEO of Tesla and the leader of the Department of Government Efficiency say to investors?
Sure. Well, good morning, and thanks for having us on. Always a pleasure to be here. By now we know that Tesla in Q1 delivered a little less than 337,000 vehicles. This number was disappointing in that it was both below expectations and actually below deliveries that the company had both throughout 2024 and 2023. For the print later today, sell-side consensus is expecting revenues closer to $19.8 billion, gross margin of about 16%, and an adjusted EPS of about 37 cents. I think for us, what we're going to be primarily focused on is going to be on management commentary, and particularly on whether Elon provides clarity on the timing of several key upcoming near-term catalysts, including the rollout of robotaxi in Texas in June, FSD adoption in both China and in Europe, and also the introduction of its lower price vehicle, whether that in fact is still on track for this year or if it has been delayed, and if so, until when. And perhaps maybe get some commentary around Optimus as well.
Before the optimism, there's still more pessimism.
Optimus, you know what Optimus is.
Oh, sorry.
It's the
optimism.
Optimus is their humanoid robot.
My head is in the gutter, and I love humanoids, as you know. But anyways, I want to talk about your reaction to what one of your rivals or peers has recently said. You have Dan Ives calling this a code red moment when you have Elon Musk sitting to lead Doge as well as Tesla. He says that Musk needs to leave the government, take a major step back on Doge, and get back to being CEO of Tesla full time. Tesla is Musk and Musk is Tesla. Do you think he's distracted? Do you think he needs to step down from Doge? Can he do this and get back investor confidence without leaving Doge?
Sure. I think investors would most definitely appreciate Elon returning to Tesla full time. I think we saw that when that rumor on Political broke out. There was a good reaction to the share price that Elon was coming back. I think investors would certainly appreciate having Elon fully focused on the business. The way that we look at Tesla today is we're seeing it's going through a transition period. It is transitioning from its automotive business to these layers of autonomy, FSD, and Optimus robot, and that's really where the excitement will come. So for this call, again, we're hoping to get some clarity from Elon around some of these timelines, and particularly if they are delayed or if they are on track.
So what would cause you to sort of readjust your call here? Because you're still overweight on Tesla. There's hope that Elon Musk is going to come out on the call today, really signal that he's still really focused on Tesla, but that's a big if. What would finally cause you to throw in the towel and maybe downgrade this stock?
Well, I think it's a great question. You know, our view is that we are very bullish on self-driving and on autonomous vehicles. Just like we are now beginning and entering the revolution of AI, we think the same applies for self-driving vehicles. Tesla, as of January, their FSD has driven over 3 billion cumulative miles. So we feel like the technology is here and will be adopted. For us, again, it's just going to be at times of like, is this timeline, can they be met, and can the company commercialize this robotaxi, and how successful will that be? The reality is that they still haven't quantified what this robotaxi will look like. We don't know how many vehicles or what the territory will be.
We were just pulling up the Optimus humanoid robot, and you can see it's very pretty. It's walking around a factory floor like it is a human, him or herself, and I don't know, the reality.
I think it is a fine pronoun for robots. I'm not sure yet, and people are going to get very sensitive, I'm sure, about those pronouns too. But
I don't think that's a big factor in the stock, though. But full self-driving, I mean, they're hoping to launch that later this summer. We know that Tesla is notorious for missing deadlines. How realistic do you think full self-driving this year is?
Well, we had a chance to visit the company's headquarters about 4 weeks ago, and we had a chance to basically test drive their latest technology. We came away from that very impressed. For anyone who has experienced FSD, the reality is the technology works. I think there's still some questions as to how will these vehicles perform, particularly in situations where there's inclement weather, since their vehicles, remember, don't use LiDAR. So I think those are big questions that investors have. But our view, again, is that we are only just beginning in this revolution of self-driving technology, and we feel like Tesla is in a great place to take a significant market share.
Andre, it's great having you on the program. Thanks so much for joining us on set. Andre Sheppard there of Cantor Fitzgerald. Coming up, Boeing is selling parts of its digital aviation unit to Thoma Bravo. We'll bring you the details of that $11 billion deal next. This is Open Interest.
Well, Boeing shares are getting a little bit of a lift today after it agreed to sell parts of its digital aviation unit for about $11 billion. The company reports first quarter earnings tomorrow. So let's get a little bit of a preview now with George Ferguson. He is the senior airline analyst for Bloomberg Intelligence. And before we get to what happens tomorrow, let's start with what happened today with this deal finally getting officially announced. We've been talking about Boeing's turnaround for a while now. It's had a really brutal couple of months here. When you think about where they are in that story, how much closer are they to finally getting to the light at the end of the tunnel?
So I would hope that the light at the end of the tunnel is going to start to be apparent in 1Q earnings. We saw some pretty good deliveries. I think they probably have a good potential for coming in at less than the cash burn the street expects. And I think you should see that progress on that plan develop across the year as deliveries continue to rise. They get rid of some of the inventory airplanes they've already built and have sitting on tarmacs. And as they get into the back half of the year, we'd expect cash generation, which again, that is the turnaround's all sort of predicated on that cash generation. This sale of Jeppesen and some other electronic portions of their business would bolster cash at the end of the year, $10.5 billion. Looks to me a bit like an insurance policy. They could probably pay down more debt with that. But again, I think we should start to be seeing this turnaround tomorrow in 1Q earnings.
All right, so there's a big deal there, and we're looking for looking forward to the earnings tomorrow. I wanted to ask about something we heard from the points guy just now. I think last week we had the CEO of Air France, and
Might have been a couple of weeks ago.
Well, he demurred when we asked, if the French are coming to New York less often, but Brian just told us it's coming through in the data that especially wealthy Europeans are traveling to the U.S. less. Do you see that coming through in the data? Because you also cover United and American, all the airlines.
Yeah, but truthfully, we've been seeing that in the data for a while, right? Europeans just have not been traveling to the U.S. The dollar has been just super strong, making it very expensive. I think inflation took a bigger bite too out of the Europeans' budgets when they come to the U.S. The price of dinner in New York City, as you know, dinner out is pretty darn expensive. I think more concerning to us, and we're watching it very closely, is as the dollar is weakening here, really the strength we heard at United, American, Delta was Americans going to Europe because Europe was on sale. The euro has really strengthened. I think the appreciation is in the 15 to 20% range. We're watching to see how that may turn the spigot on U.S. folks going over to Europe.
Yeah, certainly a pretty drastic turnaround. George Ferguson of Bloomberg Intelligence, we thank you so much for your analysis. And Katie, we're going to look at these markets. It's a little bit of green today.
Big time. We're at session highs on the S&P 500, up about 2% right now. It's big tech that's in charge, but we know that all of that could change after the bell, Matt Miller, when we finally get Tesla.
Yeah, and coming up tomorrow, Amy Kong joins us of Corian, Sarah Malik at Nuveen. And those are some voices you definitely want to hear from. This is Bloomberg.